American billionaire Bill Ackman, CEO of Pershing Square Capital Management hedge fund, just announced that he bought into a new position, and this position is the largest position in my public YouTube portfolio. Bill Ackman runs a concentrated portfolio, and he usually is 100% invested, so to buy a new position, he totally sold off another position. In this video, I'll explain exactly which position he sold and why, and what he bought instead. What's going on, investors? Hopefully guys are doing well out there. Welcome back to another video. The position Bill Ackman sold is Canadian Pacific. Let's have a look what's the reason he actually exited this position. From the perspective of revenue, the revenue was growing slightly organically until 2022, and in 2023 we can see significant jump to almost $13 billion in revenue. This jump was actually due to the merger with Kansas City Southern in April 2023. This merger created the first single-line rail network connecting Canada, the United States and Mexico, enhancing cross-border trade and operational efficiency. Canadian Pacific financed this deal with the debt. You can see in 2021 the debt level jumped from $8.4 billion to $18.5 billion, significant increase in debt, and we can also see that the debt continue climb after that. And also shares. Canadian Pacific diluted shareholders issuing new shares. You can see the share count jump from 666 million shares to north of 930 million shares. Canadian Pacific has a strong moat because this is the only company which actually connects Canada, United States and Mexico. In terms of profitability, this company continued to print cash, and we can see from 2015 this company always is profitable in terms of free cash flow. And in terms of the projections, we can see that for the next 3 years the free cash flow is expected to drive higher to almost north of $5 billion in 2027. But I will remind you that this company currently has a lot of debt which it needs to pay off. Canadian Pacific is a mature company, and mature companies should return cash to shareholders. There are two ways to return cash to shareholders. The first one is buyback and the second one is dividend. And if we can see after the acquisition in 2021 and actually acquisition went through in 2023, we can see that buyback actually dropped all the way to zero. So Canadian Pacific disabled buyback in 2022, and in terms of the dividend yield, it's very small, less than 1%. So currently Canadian Pacific has a pressure from the debt pile, and it does not share so much cash with shareholders as before. And in terms of the growth, I do not really expect the significant acceleration in revenue growth for this company. In addition, if we continue to have tariffs pressure, the international trade will be reduced, which will be a headwind for Canadian Pacific as well. And what Bill Ackman bought instead of Canadian Pacific? None other company than Amazon. Amazon is my favorite company. This company takes north of 20% of my public YouTube portfolio and a huge position in the private portfolio. Revenue for Amazon is growing up to the right, and in the next 3 years we continue to expect high single-digit revenue growth. Of course, I would hope for higher revenue growth, but this company already generated in the latest 12 months $650 billion in a single year. This is absolutely mind-blowing number. So of course from this kind of numbers it's difficult to grow, and Amazon is still growing high single digit. Not only Amazon growing the revenue, but in terms of the profitability is absolutely exploding. The cash from operations currently is reaching north of $114 billion in the latest 12 months, and we expect in December 2027 Amazon will print north of $200 billion in cash from operations. Absolutely mind-blowing. The debt for Amazon is absolutely not a problem. Amazon is printing $114 billion in cash from operations. Meanwhile, the long-term debt is less than $64 billion. So this is absolutely no issue. In terms of the business segment and what I'm the most bullish, the first one is ads. Amazon continue to grow their ads division very rapidly, and currently the growth is decelerating, reaching 19% year over year in the latest reported quarter. But this segment is already printing in the latest 12 months north of almost $60 billion. Another business segment I'm very bullish is subscriptions. Subscriptions growth is also up to the right, and the revenue mostly is recurring. And here we have Amazon Prime, Prime Video, other subscriptions as well. And this is kind of recession proof, because I don't really believe that during the economic downturn people will cancel their Amazon Prime subscription. And the third business unit I'm very bullish on is of course AWS. AWS revenues continue to grow up to the right. In the latest reported quarter is almost reached $112 billion in the latest 12 months. And the growth is reaccelerated after December 2023, now almost reaching 20% year-over-year growth for AWS. Absolutely amazing numbers for such a large business already. One of my main bullish theses on Amazon is that operating margins for retail business will increase significantly, and that's exactly what we can see. Here at this period after COVID, Amazon doubled down on the fulfillment, warehouses and logistics, and currently we can see that the operating profit is absolutely exploding, reaching in the latest quarter $25.8 billion in operating profit in North America. Meanwhile, we also have international operating income, and international operating income has a similar story with a huge investment in 2022 and 2023, and currently we are making way up for the international business, not only breaking even but printing $4 billion in the last reported year. AWS operating margin absolutely exploding. In the latest reported quarter, Amazon printed $41.9 billion in operating income from AWS alone. Absolutely outstanding numbers. Let me explain why I put 20% of my money in Amazon. Projecting the revenue of 10% in 2025, coming down to 9% in 2029. We have operating cash flow margin expanding from 18% to 22%. This is based on the robotics and cost optimization, and also price to operating cash flow of 20, which is lower than historical averages of 23. I don't expect Amazon start paying dividends. I don't expect Amazon start buying back shares. With these assumptions take into effect, Amazon has upside potential of 83% over the next 5 years, or 13% CAGR over the next 5 years. If you want to double your money with Amazon, you need to buy Amazon at $188 per share, and this is exactly what I was doing in April when Amazon went to 160. I was picking shares aggressively. Currently, Amazon is trading at $206 per share, and I expect Amazon to be $377 per share in the year of 2029. I put my money where my mouth is. If you can see, Amazon is the largest position with almost 20% of the portfolio. Currently, we have unrealized gain of 15%. Apart of Amazon, we have Google with unrealized gains of 11%, Nvidia with 16% gains, Elf with 50% gains, Meta with 21% gains, Hims with 88% gains, Microsoft with 21% gains, and the only position which currently are in the red is Evolution Gaming, minus 3% in the red. If you can see, we still have $3,600 of cash to deploy. I was buying aggressively in April, but I didn't really know that market will rebound so fast, so I did not deploy all the cash of the portfolio. Let me know in the comments what do you think about this replacement Canadian Pacific into Amazon. Would you support this or not? If you enjoyed this video, consider subscribing to the channel, and if you want to know exactly when I'm buying into the position to have such kind of significant gains like 88% on Hims, join my Discord server. We have a best community in the world. This is absolutely for free. Thank you so much, my friend, for stopping by. I will see you in the next one.